Hey there, welcome back to Crypto Clarified, Investing in the Truth. This is a podcast series where we come together to discuss the most captivating headlines and trends from the crypto space. My name's Benjamin Dean, and I'm director in WisdomTree's digital asset team. Today, I'm joined by one of my colleagues, Mirva Anttila, director of digital asset research at WisdomTree. It's going to be a great show. But before we get into it, we've got to do social media shout outs. You can always find me on the Bird app at Benjamin Dean. If you are in the US and you're a listener, go to WisdomTreePrime.com, join the waitlist, you won't be disappointed. And for all of you out there, make your lives so much easier. You just hit subscribe on whatever app you're using right now, subscribe to Crypto Clarified, and then we'll arrive in your application whenever new episodes go live. On today's show, we're going to be talking with Merva about the Ethereum Shapella update. Everything seems to have gone smoothly. It's been a bit over a week now. So investors might be sitting there and asking themselves what they should keep their eye on going forward. So we're going to totally unpack that today. It's going to be a super interesting episode. And as always, we'll finish at the end thinking a little bit about the future, because we love the future here almost as much as we love clarifying crypto. Before we start, though, I have to do my usual shout out to James and Sam in compliance. Before I begin, I need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer a solicitation to buy or sell any securities. Reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. Merva, we're on to the fun stuff now. Thank you so much for coming and joining me today. How are you?
I'm very well, thank you. Good to be with you, Ben.
Excellent. Well, I have the pleasure of getting to work with you from day to day. So I know about all the kind of interesting things that you get to work on, but it's the first time we're having you on with the listeners. So to kick things off, how about you give them a quick idea about your role as director in the digital assets research, the topics you get to cover, and what's kind of taking up most of your daytime?
Yeah, so I cover the whole of digital asset space. So obviously we have the large assets, Bitcoin and Ethereum, but we also have a multitude of other blockchains that we cover at WisdomTree. And we have different types of products that we create. So I'm really doing research on all of those areas, and obviously looking at it more from the financial point of view. My background is in portfolio management and tech growth equity investing and alternatives investing. So that's the kind of angle I come into the space.
Very interesting and a unique perspective here that I'm sure the listeners will enjoy a lot. I know one topic that's been keeping you very busy lately is the Ethereum so-called Shapella upgrade. It has gotten a lot of press, maybe not as much as the update back in September, and it's made some changes to the investment case for Ether. What are some of those changes?
Yeah, so long term, we think that this upgrade is very positive for the asset. Basically, the merge, which took place last year at the end of mid-September, it created a yielding asset, and now you can unstake, you can withdraw your staked Ether and the rewards that have accumulated in the past or since you really staked on the asset. And we think that this is really important because this creates a benchmark yield for the whole digital asset space. And the reason we think that it's important that it's Ethereum is that if we compare Ethereum to the other layer ones, there's really no comparison in terms of market cap at the moment. So the next largest layer one, of course, outside of Bitcoin, is Cardano, which has about 1% market share. Ethereum has 19% market share of the market capitalization of the space. And Bitcoin, of course, then is 44%, but it's not a smart contract platform. So this is the reason why we think it's really a benchmark yield against which all the other layer one blockchain yields can be measured against.
Got it. Yeah, indeed. The Ethereum network is at scale, and it's always so positive to see these upgrades. In this case, quite a major upgrade go smoothly, because it's difficult to do that with live software. I've seen this word Shapella. It's kind of an awkward word being thrown about, but I've also seen the word Shanghai being thrown around to describe this. Like, what's in a name? What's the deal?
Yeah, so blockchains are really layers of different functionality. And when you have a Shanghai upgrade, that really means that you're making an upgrade on the execution layer of the Ethereum network. And then you have, or that's sort of an environment where you deal with the applications and the smart contracts. And then you have a Capella upgrade, which is a software that's made on the consensus layer of the Ethereum network. And that sort of enforces the protocol rules. And so when you combine Capella and Shanghai, you get Shapella. And in fact, what's very typical here is that with Shanghai, you have already had about 15 upgrades. And with the Capella, the newer consensus layer, you've had 3 upgrades. So what it really shows is that Ethereum keeps evolving constantly.
Yeah, and really quite complicated changes as well. I also read somewhere that the reason they pull these names out, it's not random. It's because like the last Ethereum Dev Connect was in Shanghai, and then they named the next changes around stars, so Capella. And that's how you really know that at least people have got a sense of humor on the back end, even if they are making really serious technical changes. In terms of like the most consequential change from this upgrade, though, it has something to do with staking. Do you want to explain that to the listeners?
Yeah, sure. So if we just go briefly back to the merge. So what happened in the merge last September is that Ethereum moved from proof of work consensus mechanism to proof of stake. So this means that the way the transactions are verified in the network was changed to proof of stake consensus mechanism. So instead of having computers racing to solve complex mathematical problems like you do with proof of work, you have a proof of stake network where the owners of Ether can stake their ETH and participate in the validation of the transactions and securing the network. So this was what took place with the merge. And so at the time you were able to stake your Ether in the network, but you were not able to withdraw your staked coins or tokens, Ether coins, and also you were not able to withdraw the new Ether that you accumulated as a reward from participating in this network validation. So this is what happened with this April 12th event, Shapella event, and now you can withdraw both your staked Ether if you want. That's called a full withdrawal, or only a partial withdrawal, which means that you can withdraw those accumulated rewards that sort of belong to you.
It's the end of the Hotel California line that I could never get journalists to pick up. I used to describe it as Hotel California, and for whatever reason, they just didn't want to say that. But now it's gone. Right. I guess it wasn't a very good line to begin with. Otherwise, they would have picked it up. But what's interesting as well is, as you say, you can now withdraw your staked Ether and your rewards. What kind of rewards are people looking at? I mean, what is the staking yield at the moment, and how was it set?
Yeah, so at the moment we're seeing sort of yields approximately 4 to 5%. So that will depend on the number of validators who participate in the securing of the network and validating the transactions. So the more validators you have, the lower the yield would be. But it's not as simple because you also have these new types of technologies such as maximum extractable value MEV, which can increase the yield. It means basically outsourcing the block production to third parties. And also, what has been very low in the past year and a half when we've been in the crypto winter is really the transaction amount, so the applications that are using Ethereum. So that transaction portion of the yield, the transaction fee has been quite low. So typically, for example, when you buy an NFT and participate in the Ethereum network, in this case, if the NFT is built on the Ethereum network, you have to pay a fee for the right to use the network. So that's the transactional gas fee. And a proportion of that goes to the validators of the network. So it's not singular, but in fact, what we're seeing is that many people expect that this yield longer term could be even higher than that 4 to 5% that we're seeing at the moment.
It's great clarification there, because indeed it is one of these things that people might just coast over. They'll just quickly check what the number is, and some of them might be curious enough to ask why. It's not a simple answer, as you've just amply demonstrated. There's another interesting kind of investment case related dimension here, and it's around the supply of Ether, which is a function of the amount of transaction fees being paid. So what is going on with the supply of Ether in general, setting aside the staking yield, and how would that also influence the investment case potentially?
Yeah, so there is part of Ethereum, which is kind of Ethereum improvement proposal. I believe it was 1559, which was implemented in August 2021. And that introduced so-called burning to the Ethereum network. And it basically means that some ETH in circulation will be permanently removed from the token supply. And this has actually been going on since August 2021. And what we saw at the end of last year was that the Ethereum supply actually was deflationary. So we had less new ETH being issued than the amount that was being burned. So now, when most likely in the future we will have more transactions in the network, and therefore the transaction fee amount will go up, it's likely that at least on the shorter term, Ethereum supply will increase slightly, but we certainly don't expect it to go to that annual 4 to 5% increase that it was with the proof of work network. So that was the big change when we moved from proof of work to proof of stake. So that significantly reduced the annual supply of new Ether. And right now it's been deflationary. We think that shorter term, it might be sort of around break even or even slightly increase. But longer term, we think that Ethereum will have a sort of deflationary supply, which means that given if all things remains equal, you should have a pressure for a price increase, Ethereum price going up long term.
We had a guest on recently who described these things as economic experiments. And as you say, ceteris paribus, all things being equal, you would expect to see a supply crunch, and that should drive the price up. But there's another kind of element there, and it's one that might come up around liquidity. So we've now got this unstaking ability in place. We've got this deflationary Ethereum supply. How do you think these kinds of things, you've just said how it would influence the price, but thinking about liquidity, what might we need to keep an eye on there, both on the good side or the bad side?
Sure. Yeah, so when just before this unstaking event took place, so on April 12th, we had approximately 119, 120 million ETH in total supply, and approximately 15% of that was staked, which is sort of about 18 to 19 million ETH was deposited on the Beacon chain. And that probably that included the 1.1 million accumulated Ether rewards that the stakers had accumulated over the time that they had staked the Ether. So what we are likely going to see is that on the liquidity side, it won't have a significant impact on the supply of ETH, because we think that of those who had staked, maybe over 60% already had liquidity, because they had staked with either Lido Finance or Coinbase or Binance, and all of those three stakers or validators, they had provided so-called staked ETH tokens which you have been able to use as collateral if you wanted to use DeFi, for example. So those validators already had liquidity. And then you have the other group of validators who staked their ETH most likely in 2021 and 22 with a much higher price than where we are today. So we actually estimate that about half of the ETH stakers are still underwater. So if they exited right now, they wouldn't exit at a profit. So we don't actually think that all of those will exit either. So in general, we think that the exit process won't have a significant long-term downside pressure on the price of Ether for these reasons.
Yeah, thanks for that, because we haven't gone through with the listeners about these liquid staking derivative tokens in the past. It's maybe a topic for a future episode as we now see how this plays out. But indeed, it was, maybe 15 to 16% of Ether was staked. We've got now a queue of people unstaking, but then an equal queue of people trying to stake. I wonder down the line if you end up getting to something like 60, 70% of Ether staked, locked up, if you start amplifying the supply crunch in the face of the deflationary emission schedule. It remains to be seen, but there is an important piece there that is worth us explaining in this episode, because the Shapella upgrade has kind of brought this question to the fore, and it is around the queue to stake and unstake. Now, we can go. You'll be able to explain why there is a throttle or limits the amount of folks who can stake and unstake. Do you want to explain that in some detail, and what we've seen occur in the last week or so, and what we're likely to see going forward in terms of this staking unstaking dynamic?
Yes, sure. Yes. So really, it's important to limit the number of exits to maintain the security of the network. So that's why it's coded into the Ethereum network that only a certain amount of validators can exit per day. So you have two types of exits. You have so-called partial exits, which include those validators who basically just want to sell their rewards that they have accumulated over the time that they've been staking their Ether. So that's the 1.1 million that I just mentioned. And if we think that Ether typically has a daily volume of about 13 billion, so that shows that if the Ether price today is about $2,000, this would not have a significant impact on the price. And then you have another type of exit, which is the full exit, where you exit both the accumulated rewards and also the 32 ETH that you have staked. So that's a called sort of full exit. So that's you exit also the underlying principal that you've had in the network. And this is handled by a staged process, really to maintain the security of the network and also to eliminate any kind of sort of malicious actor to suddenly having an unusually high proportion of the validation process. And I believe that the network is programmed in a way where it only allows about 7 to 8 validators per epoch, which is 6.4 minutes. And that sort of translates into a maximum number of validators of 1,575 validators can exit per day. And if we think that there are over 562,000 validators, we can see that this kind of amount on a daily basis is unlikely to stabilize the network. But it also, what it also means is that this will probably take weeks, if not a few months, to fully go through. And what we've actually seen so far is that in the beginning, most of the most of the withdrawals were rewards withdrawals, and they were about 95% of the total withdrawals. But what's interesting is that actually today we're seeing a meaningful amount of principal withdrawals as well. So this is something that obviously will keep changing. But I think it was yesterday when I looked at the numbers, and the exit time for partial withdrawals was about 4 days. But if you wanted to get your Ether back as well, the principal, that would take 17 days. So that obviously will change dependent on how many validators want to exit, and how many are waiting in the queue. What we do know is that on the exit side, we definitely have Kraken, which was sued by the SEC for providing a staking as a service product. And they've agreed to stop offering their staking as a service product, so they need to liquidate their ETH. We've also seen Celsius and some other crypto lenders which went bankrupt last year, so they need to liquidate their positions. And we've also learned that some actually Lido Finance, which is a sort of liquid pool provider, they've said that due to some code audit, they cannot process a lot of the transactions until early May. And that's significant because Lido Finance is about a third of all validations. So these are just to sort of highlight the fact that it won't be over in a week or so. So we're likely to see more volatility in the price and sort of fluctuation in the price for some weeks, perhaps a few months to come.
It's a really great example of trade-offs in this space. Like, you've just touched on so many of them. One of them is the security trade-off. It'd be nice if everyone can make their assets liquid, but that exposes the network to potential takeover attacks. You got the decentralization question there. You don't want a situation where someone can go and buy 20 to 30% of the stake and thereby attack the network. You've got the going in and going out dynamic. So we'll be able to see now in close to real time the demand for staking. And then we'll be also able to see across the horizon those who are liquidating their Ether potentially to sell it for something else. It's a nice metric we get there, and it also demonstrates how the transparency of these networks, if you know what data to look at and how to interpret it, can give you really deep insights as to the behavior of this, what is essentially emergent behavior in a network. It's super, super interesting. But as you said at the end, some of these big entities have been unstaking. The queue for now full withdrawals is like 2 weeks. We'll see how that plays out over time. I imagine we'll get back to a steady state with kind of a punctuated equilibrium as you have big actors enter and exit and all the crazy things that happen in this space play out. But super, super interesting. I know we're coming up on time relatively soon. There was one last element here, and again, it's a trade-off. In the past, the Ethereum network has had relatively high fees per transaction, as you mentioned before in the NFT context. And the trade-off there essentially is the blocks only have so much space. So you've got to have people bidding essentially for space on blocks, and they express that in the transaction fee. Now, does this Shapella upgrade do anything to change or influence the transaction fees or network congestion that the Ethereum network used to experience, but could experience going forward if changes aren't made?
Yeah, no, actually. So this is really just about the unstaking of those ETH and accumulated rewards. So we will have another sort of dank sharding type of an upgrade that is up and coming, and that will address some of those capacity issues going forward.
Yeah, dank sharding. You've got to love the naming conventions with this stuff. It at least keeps you mildly entertained. Absolutely. So there are future upgrades on the roadmap. In this case, the other interesting one, I think, the layer 2 solutions for scaling now are starting to get pretty broad adoption. It'll be interesting to see if that undermines certain elements, because if indeed your staking reward is partially paid out in transaction fees, and the transaction fees being paid are going down, then that might reduce the incentive to stake or take part in general. It's uncertain, but I mean, it certainly keeps us busy as we try and pick through the many different variables and developments with this kind of technology. As I said, we're coming up on time. Usually we like to finish these episodes up by thinking a bit about the future. What's got your attention right now? I know you're looking a lot at Ethereum, so it can be Ethereum related, but also just more generally in the space right now. It's been a turbulent month as always. What's got your attention and why?
Yeah, so I'm really looking at a couple of different things. I mean, one is you already mentioned the layer 2 networks, because I think what Ethereum has actually done is that they're moving away from the sharding as a capacity increase, but moving into using these layer 2 networks as a kind of capacity increase functionality at the moment, because the layer 2s have actually come on much faster than anticipated. And what I hear now is that because the most expensive function of using the layer 2 networks is the moving information back from the layer 2 to layer 1, that Ethereum developers are actually thinking of increasing the temporary data storage on the Ethereum and allowing the layer 2 network providers to use that. And so both of them would actually benefit. You have the layer 2 networks, which can then use Ethereum layer 1 to improve, or kind of it's robust and secure. They can benefit from that. And then Ethereum can benefit from the fact that you have a layer 2 network, which typically what they do is that they move a bunch of transactions off chain, and then they combine these number of transactions to one transaction, which is then secured on the Ethereum network. And so the throughput is much higher, the costs for the user are much lower. And so I think this is something that I'm very much looking at right now. So you have the ZK rollups and optimistic rollups that Ethereum is sort of developing together with the layer 2 providers. And the other thing, of course, I can't not mention is the regulatory landscape in the US. And so you have the SEC and CFTC there, and how they define Ethereum, particularly. The chairman of the SEC has mentioned that he thinks Ethereum is a security, and CFTC has mentioned that they think Bitcoin, Ethereum, and Litecoin are commodities. So this is something very interesting to follow. And what happens there. And I think it will also have some implications for Ethereum, because it's a global market. Digital assets is a global market. So that's another thing that I'm monitoring actively.
Yeah, it is the question of the week. Is Ether a security or not? But look, it's been great to have you on, Mirva. Next time we're going to have to talk either layer 2s, ZK rollups, and optimistic rollups, or we're going to have to do, it should be a thrilling exhibition of whether what is and isn't a security. But in the meantime, as I said, it's been an absolute pleasure. Do you have any final last words for the listeners?
Not really. I think it's just that the space is developing really, really rapidly. It's moving all the time. So we think that at this particular point of time, we might be on the verge of the fourth bull market, which will be driven by these layer 2 solutions, by wallets, which is another really interesting area, developments and innovations in the wallet space, and also the applications, the sort of decentralized applications that are now being developed for gaming, NFTs, etc. So that's perhaps something for future episodes.
If people want to keep an eye on the different publications you put out, where can they find it on the interwebs?
Yeah, so on the WisdomTree Europe website, or I'm also trying to post most of it on my LinkedIn.
Excellent. Great. Well, with that, we're out of time. I hope listeners found today's podcast useful and informative. If you're in the US, join WisdomTree Prime's waitlist at wisdomtreeprime.com. You can find me at Benjamin Dean on the Bird app. And as a reminder, if you'd like us to cover any specific topics in a future episode or to find out more information, please email cryptoclarified@wisdomtree.com. Thank you again for listening, and we hope you have an excellent day.